In July of 1997, one country pulled one lever. And within a year, half of Asia was on fire. Currencies collapsed. Banks failed. A leader who'd ruled for 3 decades was gone. But here's the part nobody talks about: a handful of investors saw the smoke and ran toward it. I've watched a lot of panics in 50 years. But the Asian crisis taught me something I've never forgotten. It showed me exactly how fear travels, how one crack becomes a flood. And it showed me how value gets created in the rubble. So today we're walking through what happened, why it spread so fast, and the one lesson that separated the people who got wiped out from the people who got rich. The third section is the one most investors get completely wrong. For years, Thailand looked unstoppable. Foreign money poured in. The economy boomed. And the Thai baht was pegged to the US dollar at around 25 to 1, rock solid, or so everyone believed. But underneath, the country had borrowed enormous amounts in dollars. When speculators bet against the baht, Thailand burned through its reserves trying to defend it. And on July 2, 1997, they gave up. They let the baht float. It didn't float. It sank. By early 1998, the baht had fallen to around 56 to the dollar, losing more than half its value. Every dollar of debt Thai companies owed had just doubled overnight. That's the trap of borrowing in someone else's currency. And the fire was just getting started. Here's what makes a crisis a crisis. It doesn't stay put. Investors looked at Thailand, then looked at its neighbors, and thought, same problem. Pull the money out. Now. Indonesia got hit the hardest. The rupiah went from around 2,400 per dollar to over 16,000 by the middle of 1998. Think about that. Savings gone. Prices exploding. And the economic collapse triggered a political one. In May of 1998, President Suharto resigned after 31 years in power. South Korea, a genuine industrial giant, needed the largest bailout the International Monetary Fund had ever assembled at that time, about $58 billion, agreed in December 1997. This wasn't a small economy stumbling. This was contagion. Fear moving faster than facts. And while most of the world saw only disaster, a few people saw something else entirely. This is the part investors misunderstand. When a currency collapses, it doesn't just destroy bad companies. It drags down the good ones too. Excellent businesses, real factories, real customers, real cash flow, got sold off simply because they were in the wrong region at the wrong time. Their prices crashed. Their value didn't. Look at South Korea. The country swallowed brutal reforms. But its great companies kept building. And the recovery was stunning. Korea repaid those IMF loans years ahead of schedule, by August 2001. An investor who bought quality Korean and Southeast Asian businesses near the bottom when everyone else was screaming sell captured one of the great rebounds in modern market history. This is Benjamin Graham's lesson made real. Price is what you pay. Value is what you get. And in 1998, the gap between those two was the widest it had been in a generation. Now, I'm not telling you to go catch falling knives. This is educational, not financial advice. But understanding why this works is everything. Not every country played by the same rulebook. Malaysia did something almost nobody expected. In September of 1998, Prime Minister Mahathir slammed the door, imposing capital controls and pegging the ringgit at 3.80 to the dollar. The experts called it reckless. It worked better than they predicted. And up in Hong Kong, the Monetary Authority went to war with speculators directly. In August 1998, the government bought up local stocks, committing roughly 118 billion Hong Kong dollars to defend its market. Years later, it sold those shares at a profit. The thread connecting all of it? The people who survived had two things: discipline and dry powder, cash ready to deploy when others were forced to sell. Panic is loud. Patience is quiet. But patience is what gets paid. So here's what the Asian crisis really teaches us. A crash doesn't ask whether a business is good or bad. It sells everything. And that is exactly when the prepared investor goes shopping. Fear is contagious, but so is opportunity, if you've trained yourself to see it. The crowd sells the region. The patient investor buys the business. Be fearful when others are greedy. And be greedy carefully, with a margin of safety when others are running for the exits. So let me ask you something. If a crash hit tomorrow, would you have the cash and the nerve to act? Tell me in the comments. I read them. And if this changed how you think about market panics, hit subscribe. We do this every single day. Tomorrow, we're breaking down a mistake that's quietly costing patient investors a fortune. You won't want to miss it.